Hello, welcome to Charting and Trading Analysis Part 2. My name is Peter Mueller and I have designed this video series to help you to make better investment and trading decisions by using simple charting techniques and some technical analysis. Please feel free to share this video with your friends and colleagues who might have an interest in investing and trading. In today's session, we will cover some elements like trend and noise, simple moving averages and crossover. We also will analyze certain techniques like simple, weighted and exponential moving averages. And we will also talk about the magic moving average numbers as they are referred to in the literature and what they mean in these days. We will also look at crossover techniques and trend reversal, and we will also talk at the end about crossover rules. Now, in order to follow this video tutorial, you need to go to your internet and simply type in your browser finance.yahoo.com/chart/GLD, and you will get the chart, what you see here on the right hand side, which will show you the 1-year chart of the ETF GLD, which represents basically the price of gold. Now I go into full screen that you can see everything what I'm doing, and you can follow it later by repeating what I'm demonstrating to you. I'm just at the beginning showing you a little bit recap from our series, from our first video, where we showed you how to build some basic charts. As you can see here, where the cursor is on the right hand side, showing you the price of gold, and here you see it shows you the open, the high, the low and the close of the point where the cursor is. So at the moment, when you look at the bottom, it shows you from February 2nd, 2019, the open, the high, the low and the close. And when I move it to the very end, today we have the 29th of October, you will see the price at 4 o'clock. The open was $140, high was 140.63, the low 139.78, and the close 140.25. The first thing I'm going to do, I click on the GLD box and I change the color of the line to black, and I use the third strength here to have a thicker line representing the historical movement of GLD. Remember, I showed you last time, whenever you look at stock charts, you should always look at different time intervals. And just a very brief recap, we have 3 ways to look at the different time periods. Number 1, we have here data range. When we click on it, we can simply choose any kind of starting point. We can go back into history, as you can see, and we can choose today is the 30th of October, and by applying the data point you will see the interval we have chosen. For simplicity purposes, I go back here on the preset for 1 year, which will show us the GLD chart for 1 year. You can see we have 1 day, 5 day, 1 month, 3 months, 6 months, year to date, 2 year, 5 year and max. So we have a variety of time intervals we can look. And before making any trading decisions, we should really look at multiple time intervals. And the third method is we have down here the method of going to the plus sign, which always will zoom in, and on the other hand, with the minus sign, we will zoom out and make the time periods longer. But now let's go back to the preset to 1 year. So it is data range preset or the plus minus sign. And for those who use the mouse, if you use the roller between the roller between the right and the left mouse click, you can also move the chart and the time horizon. But now let's go back to the 1 year chart and let's have a look what we can do. We talk about today about trend and moving averages. Now, what is trend? Trend is the consistent change over time in a given direction. And normally this is done by drawing some lines. And let me give you an example. We use the draw tool on the very right hand side. I press draw, I select first a color for the line I'm using that you can see quickly. I'm choosing red and I'm choosing now the second relatively thick line here, and I am using here of the various options I'm using trend line, which simply connects 2 points I'm choosing. I'm a pretty good eyeballer in trend, so let me show you. I go to the left hand corner and I say here is 1 point, and I move to the other point. In this time period I think we have a pretty good trend. And you see the line says we have 67 trading days and we had an increase of the price of the stock of 9.53%. Then I see here a declining part. So I just simply go choose a point where I think the trend began, make my first data point, and then I go to the second data point. And here I have 64 trading days and I have a decline of the stock price of GLD, of the ETF, of 3.46%. Let's continue, and I say, okay, this looks good. My starting point is here and my ending point is here. We have 67 trading days and have an increase of 19.3%. So these are trend lines, and you can also use regression techniques to do this. So, and here within 43 trading days I have a decline of 3.2%. This is the way to look at it simply by eyeballing. Now, another mathematical way to look at to get some curves which are more closely related to the actual stock chart is building moving averages. Okay, now we have seen this. Now let's clear the deck here from our trend lines, and let's remove the drawing tool and let's go to the moving averages. Now, for moving averages, we go here to the indicator and we see we have a plethora of indicators we can see here. Let's go to the first one and let's choose a moving average. Let's start with a 5-day moving average, which says the moving average of 5 trading days, which is 1 week. And let's keep it as a simple moving average, and let's make this in blue and have a look at it, how it looks like. You see the 5-day moving averages goes relatively closely to the black line of the ETF. Now let's build another one and let's have a look if we double it, or let's say we triple it to 15 days moving average. And 15 days, this would be 3 trading weeks. And let's have a look, and we see we have a much smoother curve here, but the distance between that red line and the actual trading changes a little bit. Now, in order to demonstrate this effect furthermore, let's take the 50-day moving average and let's keep the purple line here and look at it. And then we see the 50-day moving averages goes very smoothly, but we can see very big difference between the moving average and the various curves. So what we keep to remember now here, we have to remember the following. The fewer days we include in the moving average, the closer it will follow the actual line of the underlying security, in this case the GLD ETF. So let's keep this in our memory. Here we have the 50-day, we have the 15, and we have the 5. Now let's clear the deck again here by removing the moving averages by simply clicking on the X, and we remove the moving averages. And now we are testing different types of moving averages, but using the same time interval. So let us take the moving average, and let's say we take a 15-day, the 3-week moving average, and we keep it simple moving average, and let's make a green line out of it, and we see the 15-day moving average, which is a pretty smooth curve here. Now let's choose another one, the moving average 15 days again. So we keep the same number of days, but we choose now the exponential moving average, and let's make this in color in red, and let's have a look at it. So we have the same time interval, but we see most of the time the red line is coming a little bit closer to the actual number than the green line. That's what exponential techniques are doing. Let's select a third one, a third technique, which is the weighted moving average. And let's make this one now a dark blue and have a look at it. And sorry, this was 50, I have to go back. This was, and as you can see, I just go back and change the 50 to 15. And now you see the blue curve gets even closer to it. And the weighted moving average is one of the techniques which is used frequently. But I personally, I tell you, I am, in most of the cases, use exponential moving average. To show you finally another technique, the double exponential smoothing average. The double exponential moving average, and making this one, this is not easy to see. Let's make this one brownish kind of, and you see the double exponential smoothing goes even closer. But it gets so close that you see a lot of zigzags early here. This is called, when you follow this, that you are being kind of whiplashed. It goes in and out and in and out, and it does not keep a consistent pattern steadily straight upward or steadily downward. Now, remember, so we see the techniques, simple moving average, which is relatively far from the actual data, exponential moving average gets it closer, and double exponential moving average gets it closer even more. Now, as you can see here on the top for you, it is then very simple to manipulate to create any kind of chart. So let's eliminate the double exponential smoothing one. And on one chart, just to remember, you should not mix different techniques. You can mix, obviously, for crossover analysis, different time frames, and that's what we are going to do now. But when you have on a chart moving averages, they should be all from the same technique. So using only simple moving averages, or only weighted moving averages, or only exponential moving averages. Now for that matter, let's take an example here. Let's make the first one now a 5-day, and let's make it a simple exponential moving averages and keep it green, and make a second one. Now we have it. We have a 5-day moving average, exponential moving average up here, which is red, and we have a green one, which is a 15-day moving average, exponential smoothing. And you see here, let's zoom in a little bit. We have some cases where they cross over, as we can see here and here and here. In order to demonstrate the crossover phenomenon, I have prepared another chart. I'm using UCO, which is a leveraged ETF, which reflects the oil price. And I've taken a 1-year chart, and as you can see, I have a 15-day moving average exponential in red, and I have a 5-day moving average in green. These are the same two intervals I had, and here I have highlighted the crossover points it has during the year. And as you can see, if you would use those crossover points, you could have made some money. You would have bought here and sold here. And here are two crossover points, as you can see. It's a kind of an in and out twice. It would be called a whiplash. But then again, if you bought here and you sold here, because here it was very close together, or latest you should have sold here, you still would have made a nice gain. On this, you would have sold here, so you wouldn't have lost all your gains here. And then if you look around here, here was another opportunity to go in, and you would have gone out and you would have made a small gain. And then when we didn't have a lot of trend in here, you see we had a lot of crossover points here, and this technique doesn't generate good entry and exit points if you don't have a strong trend upwards or a strong trend downwards, as you can see here. So, but once we have a strong trend and we have good reversal points, when it changes as here, you can see you can use this crossover technique very well to identify buying and selling points. You could also you could simplify the method and simply choose one given, and let's go back to the gold chart. You can use only one single moving average, and in this case I took a 15-day moving average, and you say when the actual entry point, when the actual stock crosses the moving average, this would be this point down here, and let's highlight this point here in this particular case. Let's highlight this point. So, okay, this would be one point, and then when it crosses here, it comes from the top down. Here are 2 points. Here are 2 crossover points where you should have gotten out, but this was also a potential entry point here again, and here is the other exit point. So you could have gone in here, going out here, but you had 2 crossover points, one when it went down and immediately it crossed back again. You could have bought back again and sold here. So by using a simple moving average, you can apply the same crossover technique. However, in order to have more stable and more verified signals and points, you should use crossover from 2 moving averages. And there you have always a long moving average and a short one. In this particular case here, I have a 15-day moving average. The 15 is a pretty long time interval, and the short moving averages, most traders, they are somewhere around 5, which is typically a trading week. And as I've shown here, the 5-day moving average here, and I just have to change it to exponential moving average. The 5-day moving average would have given us the same crossover point. The 5-day and the 15-day, they were crossing here and they were crossing here. But you see, by using the 5 and 15 days, we didn't have two crossover points, we did have only the one here coming in. And here the selling point, the crossover point, would have been a little later. Okay, I hope this gave you a first idea how crossover actually works. And for crossover analysis, we have to remember the following important points. Moving averages are used to identify trends, trend changes, and trend reversals. Weighted, adaptive, and exponential moving averages are more sensitive to the most recent historical data than the simple moving average. The fewer number of days you include in the moving average, the more closely the moving average gets to the most recent data points. Exponential moving averages are the most popular moving averages. I use them the most myself. My most crossover models are using single exponential moving averages. And then there is a rule of thumb where you simply say, when you think about what moving average should I use, you always want a moving average to be as short as possible to identify the beginning of a new trend, but as long as necessary to avoid being whiplashed, as we have seen in the one example. And the crossover points of moving averages often serve as signals and indicators for possible entry and exit points for trading stocks. I personally use these crossover points as one of 5 indicators to make decisions for trading. So this is only one of 5 which I'm using before make a decision. All right, let's summarize this session in brief. Always test different time intervals and different moving average types before making any trading decisions. Don't mix types of averages in one chart. So using a 15-day simple moving average and a 10-day exponential moving average. Don't do that. Use for 2 moving averages either the simple or the exponential one. Use a combination of 2 moving averages to spot meaningful crossover points. Now, if you choose a short and a long one, my rule of thumb is the long one should be at least 3 times should include 3 times as many days as the short. Meaning, if I use a short moving average of 4 days, the long one should be at least 12. If I use 5 days as the short, 15 should be the long one as the minimum. Or I can go even higher to 4 times, using, for example, a 5-day moving average and a 20-day moving average. Now look over multiple time intervals to verify the validity of crossover signals. You have seen this when you go over a year, over 3 months, over 5 years, you get a pretty good feeling if an historical crossover point is a valid technique. My rule of thumb is there, if 7 out of 10 crossover points really indicated a change in trend, then I have found a pretty good model. All right, remember still that each stock or ETF has its own rhythm and algorithm. So play around with it for each of your investment vehicles you are watching where you want to make trading decisions. There are no universal technical indicators or magic moving averages which work across all investment instruments. Always use a set of customized indicators. All right, that's for today for technical analysis and charting section 2. In our next segment, we will talk about the Japanese candlesticks. And please feel free to change this video with friends or colleagues who are interested in trading and investing. Thank you very much and see you soon for chapter 3.